Hi there. Do you own a small business? Do you have earned income as a self-employed individual? Are you looking to make higher contributions to a retirement account on an annual basis? Are you looking for additional tax deductions? So if you've answered yes to one or more of these questions, a small business retirement account can be a good fit for you. In this brief training, we will review 3 business retirement accounts that you could potentially take advantage of. And keep in mind, as we progress through the training, that all of these accounts can be self-directed into alternative assets. This means that you can use these accounts to invest in real estate, mortgages, trust deeds, private lending, private equity, real estate investment partnerships, precious metals, in a wide array of alternative assets. So let's get started. Let's get to the whiteboard and break down these 3 plans for you. Okay, so we're going to dive into each one of these plans, and I'm going to show you the pros and cons of each individual account. The object of this video training is that you have a better understanding when you leave here today on what business retirement account is going to make the most sense for you. I would then encourage you to team up with your CPA, your accountant, your tax attorney, whoever that professional might be that works to help you and consults with you on your business and your personal finances, to make sure that they're on the same page in terms of what plan is most attractive to you. You can then team with Equity Trust Company as one member of your financial team to put the plan in place, to set up and fund the account. So let's start with the first business retirement account, which is the solo 401k. So to start, it's important to understand with any of these business retirement accounts that you are wearing both hats as a business owner. You may have heard of this before. As a business owner, you are an employer hat, so you're wearing an employer cap, and then you are also an employee. So it's important to understand that analogy as we progress through the training. You're wearing both hats as a business owner, an employer hat and an employee hat. So let's dive into the solo 401k. There is both an employee contribution and then also an employer deferral. A lot of people think of this like a match. When you go and work for a company and they give you a 401k option, you make contributions and then they might match you up to a certain amount. As a business owner, you can have a solo 401k, providing you meet all the requirements, and you can make an employee contribution, just like you can with a company you work for. And then there's also what they call an employer deferral component. So we'll talk through that. Now, a couple of items to talk about before we get into the contribution limits or how much you can put into this account. To be eligible for a solo 401k, you have to have established earned income. All right, so what is established earned income? Well, think of it this way. It's income that you are paying ordinary income taxes on, so federal, state if applicable, and local income taxes, and then also payroll taxes. So think self-employment taxes, Medicare and Social Security. So a lot of business owners might be familiar with filing a Schedule C and a Schedule SE, self-employment. So ultimately, it's not your gross, but it's your net income, if you will, that's going to be applied to these figures. I will dissect this in just a moment and give you an example, a real-world example. Okay, so let's talk about how much money you can put into one of these business retirement plans, particularly a solo 401k. With a solo 401k, if you are under the age of 50, you can contribute up to $19,500. Keep in mind, it's up to 100% of your earned income, not to exceed $19,500, which means, let's say you're only paying yourself $20,000 as a realtor, for example. Well, you can put the full $19,500 into the plan because it's up to 100% of your earned income, not to exceed $19,500. And you'll see here that when you're 50 years old or older, you have what's called a catch-up provision. So the government says as you get older, you can put more money into a retirement plan. That goes for IRAs as well as solo 401ks or 401ks in general. So $26,000 on the contribution limit if you're 50 or older. Again, in recap, wearing our employee hat, we can contribute up to $19,500 when under 50 and up to $26,000 when we are 50 and older. All right? Now, we move the employee contribution aside And now we have our employer deferral. So we put our employer cap on. As an employer, we can defer up to $37,500 of our income, not to exceed 20% of our self-employment income or 25% of our W-2 income, all right? So I'll write that down. That's 20% of self-employment or 25% of if you are paying yourself via W-2. For example, if you're an S corporation, you're filing as such, and you have consistent W-2 income that you're paying yourself through like payroll deferral, you're going to use a 25% calculation. There's a calculation that goes into play. You can look on the IRS website for this on why, if you're self-employed and paying yourself as such, it's 20% compared to 25% if it's W-2. Okay? So you're limited by 20 to 25 or 25%, not to exceed $37,500 between the employer deferral and the employee contribution. When you are under the age of 50, your maximum allowable contribution to a solo 401k is $57,000. When you're 50 and over, it's $63,500. All right? In other words, how much money can you get into a solo 401k? Well, if you're paying yourself enough, you could potentially get upwards of $57,000 when under the age of 50 and up to $63,500 when you are 50 and over. So for those of you that are claiming a significant amount of earned income through a business, you can see that you can defer a significant amount of money into one of these plans that goes well above an IRA contribution. In another video training, we talk about IRA contributions. With an IRA, you can contribute up to $6,000 when you're under the age of 50. When you're 50 and over, you can contribute up to $7,000. With a solo 401k for your business, as you can see, you could potentially defer higher amounts into one of these programs. So that moves us right into some of the pros and cons of the solo 401k. Obviously, as we were talking about, contribution limits, right? You can contribute significantly larger amounts compared to an IRA. Do keep in mind that if you are contributing to an IRA, that is completely separate from this solo 401k. So you can max out your solo 401k and you can also max out your IRA on an annual basis. Number two, tax deductions. So this $19,500 or $26,000 and then your employer deferral combined up to $57,000 or $63,500 can be entirely tax deductible if you choose to, which means if you maxed out being under the age of 50 and you got the full $57,000 in there, you would get a $57,000 tax deduction. With a solo 401k, you can elect to make tax deductible contributions, or you can elect to make tax-free Roth contributions. Now that's an interesting concept and leads us to the next pro of a solo 401k is the Roth component. So this $19,500 or $26,000, you can contribute into the Roth component of the solo 401k. Here at Equity Trust, as we provide the administrative and custodial services for a solo 401k, built within our plan document, you have the Roth component. All you got to do is cut the check or send the wire and make the contribution to $19,500 or $26,000 depending on your age. And that's all after-tax dollars. The beauty of it is those after-tax dollars are going to create more after-tax dollars. And you're going to be able to leverage what we call compounding interest in the absence of taxation. And I'll pause there for a moment and say that a lot of our real estate investors that come to us, they're very attracted to that Roth component because they understand the opportunity of being able to create wealth tax-free. And when they start taking distributions from this account after the age of 59 and a half, they have 0% tax on those distributions, providing that they run everything properly. So there can be a lot of advantages with this Roth component. All right. With the Roth component, note that there are no MAGI limits. So with a Roth IRA, if you make too much money, you may not be able to contribute directly to the Roth IRA. You might have to do what's called a backdoor Roth IRA. With a Roth component to a solo 401k, there are no income restrictions. You just have to have earned income in order to make the contribution. The next one is you can potentially avoid unrelated business income tax on leveraged real estate. So some of you might be familiar, and we have other training videos about the UBIT concept, If you buy real estate in an IRA and you take on a loan, you will likely pay unrelated business income tax on your net rental proceeds or the net profits from the sale of the property while there's leverage. And it's based on a percentage of the property that is leveraged. So for example, if you buy a property for $100,000 and you get a loan for $50,000, you have 50% debt on the property. In an IRA environment, you're going to have to pay taxes on 50% of your net profits because you have that leverage. In a solo 401k environment, providing that the loan is structured properly, you are exempt from that UBIT. So that's an important takeaway for those of you that are real estate investors. Keep in mind that that UBIT mitigation does not apply if you're going to run your solo 401k like a business, like a trader business. The UBIT only applies to debt leverage real estate. Last but not least, if you have a spouse that is working for you in your business, even if they're not a partner in the business, as long as you are paying them a salary or paying them a wage and they are claiming that, they can also take advantage of the solo 401k as a participant of the plan. Now that leads me to requirement number 2. We talked about requirement number 1 of a solo 401k is that you must have earned income. Requirement 2 is that you cannot have any W-2 employees with the exception of a spouse. So for those of you that don't have any employees, you don't plan on having employees, a solo 401k could certainly be a good fit for you. All right, on the con side, which you can see are less than a lot of the advantages, I mentioned you can't have any employees. So if you do have employees or you want to eventually have employees, you're going to have to look at a multi-participant 401k. It can be a little bit more administratively burdensome than a solo 401k, but if you need to take advantage of that, you could still self-direct it into alternatives. The next is there is a requirement with a solo 401k. If you have over $250,000, you have to file what's called a 5500. With an IRA, you're not required to file a 5500 if the plan breaches $250,000. It's not overly difficult, but administratively, it will be a cost for you on an annual basis once the plan breaches $250,000. Next, substantial and recurring contributions. So I've heard of a lot of investors in the self-directed IRA, real estate space in particular, that will say, hey, I have a solo 401k, John, and I've never had any active earned income through a business. The company that I set up the solo 401k with told me that I didn't have to have any active earned income in the business. I just have to have the intent to make contributions to the solo 401k from the earnings that I've generated in the business. Directly from the IRS website, it states that contributions must be substantial and recurring. Now, yes, it's a facts and circumstances situation, right? Check with your CPA or tax attorney on this. But the argument, right, is that if you set up a solo 401k and you never make a contribution, maybe you don't have even earned income through that business, that you have not met the substantial and recurring contribution requirement that the government sets forth when they've created these plans in the legislation and in the IRS necessary publications. So it's important to understand that if you are looking to set up a solo 401k, you want to self-direct it into real estate, that you meet the minimum eligibility requirements, and most importantly, you're going to take full advantage of the features of the solo 401k, the higher contribution limits, the potential tax deductions, the advantages of the Roth component. The solo 401k can be a far superior retirement plan compared to many other retirement accounts, but ultimately you have to understand how it works and you have to set it up properly. Equity Trust Company can facilitate establishing the solo 401k for you and providing the necessary record keeping and administrative and custody services that go along with that. After this video is over with, you'll be able to get direction on how to get started, okay? Last but not least on the solo 401k, and this is sort of a 301 and 401 type strategy, you could actually take your employer deferral, this 37.5, and you can do what's called an in-plan conversion into the Roth component of the solo 401k. So the key takeaway for all of our viewers is, guess what? If you're making enough money, if you're paying yourself enough, you could potentially get up to $57,000 into a Roth component of a solo 401k in 1 year. When you're 50 and over, up to $63,500. And imagine what you could do with those after-tax dollars, investing in real estate, notes, and all of these other alternative assets, creating tax-free profit, and leveraging compounding interest in the absence of taxation. So really exciting plan. Let me go ahead and jump over now to the SEP IRA, okay? The SEP IRA stands for Simplified Employee Pension Plan. Simplified Employee Pension Plan. The SEP IRA came about in the late 70s as a sort of healthy alternative to a company-sponsored pension plan, which, as we all know, could be potentially more burdensome, could be more costly, could be a little bit more difficult to manage and run. The SEP IRA gives you the characteristics of a pension plan, but in an IRA system. So easy to set up, a little bit lower cost in many cases. The way a SEP IRA works is you're really only contributing wearing one hat. So when we talked about the solo 401k, you were making a contribution as an employee, and then there was that employer deferral. So you were wearing both hats and you were making contributions as such. With the SEP IRA, you're only making an employer contribution. So you put on your employer hat and you can contribute up to 25% of your salary if you're W-2. Okay, this is if you're W-2. If you are an LLC disregarded and you're filing a Schedule C and Schedule SE, you're going to use 20% as the figure. Okay? So you can contribute up to 25 or 20% depending on your situation of your income. That would be after all of your expenses, the income that ultimately you're paying Medicare and Social Security tax on and ordinary income taxes. All right, not to exceed $57,000. This is for tax year 2020. Okay? Now with a SEP IRA, you could potentially still make a contribution up to your tax filing deadline. So for 2019, it's $56,000. That's an important piece to note. So up to $57,000. Let me give you an example. Let's say you're paying yourself $100,000. And when I say you're paying yourself $100,000, I'm saying that you're paying self-employment taxes on that $100,000. So that's your Medicare, that's your Social Security tax, all right? You have $100,000 in earned income. And let's say you're an LLC, disregarded, pass-through income, you're filing a Schedule C and a Schedule SE, $100,000 post to your Schedule SE, and we're going to take 20% of that $100,000, which is $20,000. So your $100,000 income, you defer $20,000 into the SEP IRA, which is a significantly higher contribution than an IRA, which again is $6,000 or $7,000. And the SEP IRA is a tax-deductible account. So you're going to get a deduction for that $20,000 contribution. All right? Now let me go back to the solo 401k for a moment so you can see the example in the contrast between a SEP IRA and a solo 401k. So with a solo 401k, let's take the same business owner, and they make $100,000. That's earned income. And let's assume that this business owner is 50 or older, so they can contribute $26,000, okay, as an employee, and then put our employer hat on, and we take 20% of that $100,000, which is $20,000, okay? So that gives us a total of $46,000. So you see here, comparing and contrasting, with a SEP IRA, if I'm paying myself $100,000, I'm limited to only contributing $20,000, and it's only a tax-deductible contribution. With my solo 401k over here, I pay myself $100,000, I put $26,000 as an employee contribution, I do my $20,000 deferral, I get a total of $46,000. And guess what? Even though this $20,000 has to take a pit stop, if you will, in the tax-deductible portion of the plan, I can do that in-plan conversion, get it all into the Roth component, and now I've just created $46,000 in tax-free dollars that are going to grow tax-free for the rest of my life. And I can leave them to my children, grandchildren, my spouse, or whomever else I want to in a tax-free environment as well. All right? So now you start to see the pros and cons of these plans. Pros on the SEP, potential tax deductions for the business, right? Maybe that's important to you. Maybe the Roth isn't as important, but tax deductions are important. That's okay. Admin is typically easier, as I mentioned, compared to like a defined benefit plan or pension plan, employer-sponsored plan. Higher contribution limits, of course, compared to an IRA. Some of the drawbacks to this, which you've already started to see, is that if you have employees, imagine having to contribute not just 20% to your plan, but also 20% for any eligible employees. So with a SEP IRA, if you have employees, you are actually writing a check from your business to their plan if they meet the minimum eligibility requirements. You can check out the minimum eligibility requirements on the IRS website. Generally, it's employees that have worked for you 3 out of the last 5 years, who are 21 years of age or older and have made over a certain amount in the current year and previous year. You have to contribute to theirs if you're also contributing to theirs, contributing to yours. So you do want to make sure if you have employees that you do the math on, does it make sense for you to have a SEP IRA? No Roth component. So with the solo 401k, you have the Roth component. With the SEP IRA, you don't have that. And again, you're limited by 20% or 25%. So you could see the difference between the two examples. You can get significantly higher amounts in the solo 401k compared to the SEP IRA. All right, let's go ahead and jump into the last business retirement account, the simple IRA. So this is the Savings Incentive Match Plan for Employees, simple IRA. Came about a ways after the SEP IRA, but a little bit before the solo 401k. I like to refer to the simple IRA as a hybrid between an IRA and a 401k. If you do have employees for a business and therefore you don't qualify for a solo 401k or you don't qualify for a SEP IRA in the sense that you'd be running a much more costly plan for the business, a simple IRA might be a good fit for you. It can be a lower cost way to have a retirement plan for you and your employees that are eligible. So let's talk about contribution limits. How much can you contribute to a simple IRA? $13,500 as an employee contribution when you are under the age of 50, $16,500 when you're 50 and over. Again, these are for 2020, all right? These are the limits for 2020. If you're watching this in a future year, just check out the IRS website for the updated contribution limits. They generally do change year over year. So $13,500 or $16,500. Just like the solo 401k, this is up to 100% of your earned income, your established earned income. So if you're only paying yourself, let's say $14,000, you're under 50, you can get the full $13,500 in the plan. Whereas with the SEP IRA, you're limited to that 20% or 25% figure. Now with a simple IRA, like the solo 401k, you're wearing 2 hats, an employer hat and an employee hat. As an employee, you can contribute these amounts, and then as the employer, you can match 1 to 3% of your income. So let's go ahead and give you another example, just like we did before. Let's say you're paying yourself $100,000, okay? And you are 50 or older. You can put $16,500 into the plan, and then you can match 1 to 3%. So let's say you do the maximum match of 3%. 3% of $100,000 is $3,000. That gets you a total of $19,500 into your simple IRA. So there's some advantages, as you can see there with the simple IRA, especially if you have employees. You can contribute higher amounts than an IRA, which is $6,000 or $7,000. This is a tax-deductible plan, so you get a tax deduction for it, right? But on the con side, as you can see, the $19,500 is less than what you could contribute here to a SEP, not by a large margin, but by a $500 margin, and certainly a lot less than the solo 401k, all right? But again, the advantage that you pick up on the simple IRA that you don't have with the solo 401k is you can have employees for this plan, right? And they can take advantage of the benefit as well, and the match that you make as an employer is a tax-deductible match for the business. So you see the pros there. Obviously, you avoid added maintenance, potentially higher contributions compared to an IRA, and then you have the benefit to the employees. On the con side, you'll see no Roth component with the simple IRA, unfortunately. And also, with the simple IRA, you have to have it for 2 years or more before you can roll it over or convert it to a Roth IRA or transfer it to another type of IRA. So the SEP IRA, I could take that money and convert it right away to a Roth, whereas the simple IRA, I have what's called a 2-year seasoning period. So now that you've seen an example of if I pay myself $100,000 in each one of these categories, and you've seen the pros and cons, you can make a decision on what business retirement account is going to make the most sense for me or make sense for you. So what I would encourage and challenge you to do is team up with your CPA or your tax accountant and verify what business retirement plan is going to be a good fit for you. They'll be able to instruct you on how to max out that contribution on an annual basis. And then from there, it's all about using that money and investing in what you see best fit for your retirement. For a lot of our clients here at Equity Trust, it's investing in alternative assets such as real estate flipping, buy and holds, rentals, vacant lots, raw land, lending money secured by real estate, mortgage notes and trust deeds, investing in real estate partnerships and syndications and crowdfunding, and all of these other alternative assets outside of just traditional stocks, bonds, and mutual funds. For more information, you can check us out further on our website. Make sure to subscribe to our YouTube channel as well for all of our new and upcoming updated videos. We look forward to seeing you on the next video training.